Bryan Rich from Money and Markets TV. The dollar has staged a broad rebound over the past month, surprising many people. But I wasn't one of them. It seems like every time the dollar turns down, we hear all of the predictions about its imminent demise. That was the case more than ever during its recent decline. And those yelling the loudest were as sure about their predictions as those zealots who thought the world would end on May 21st. This type of frenzy and hysteria is nothing new, not for the dollar, not for financial markets. In fact, it's typical of every boom and bust trade, and it's typical of markets that are at major turning points. I was recently reading a Time magazine article entitled "The Shrinking Role for U.S. Money." It said, quote, "As the dollar is being eased out of the cornerstone position it has held since World War II, gold and some strong currencies are moving in." And it quoted a German Bundesbank official saying that the world is moving inexorably toward a multi-currency arrangement. The quotes aren't that surprising. We've heard similar arguments from dozens of experts recently. But you may find it surprising that this Time magazine article was from October of 1979. When it was written, the dollar had been languishing against major currencies for about a year. But over the next 6 years, it doubled in value. Of course, the dollar's relative weakness in the late 70s had a lot to do with the political and economic challenges of the time. But the point is, despite all of the panic and doomsday scenarios, the dollar didn't go away. To the contrary, it remains the most important currency in the world today. The recent sentiment against the dollar is a perfect example of investor behavior overpowering all economic fundamentals. It can happen to a market on the way up or on the way down. This fear or greed tends to drive individuals to seek safety or profit in numbers. It's this herd mentality that drove the technology boom in the late 90s, and it drove the housing boom of the last decade. The same goes for the anti-dollar trade. And because markets have become so interrelated, the fear of dollar destruction has also caused investors to herd into other asset classes, dreaming of huge returns in a hyperinflation scenario. And these other asset classes might include stocks, foreign currencies, and commodities like precious metals. You can see this massive shift away from the dollar in the CFTC's Commitment of Trader report, which shows how market participants were positioned early this month. The light blue shaded area to the far right of the chart shows that the net short position on the dollar has been getting more and more extreme. And you can also see from the dark blue line that when investors lean so heavily in one direction, the dollar index tends to revert. In recent years, these turning points have resulted in violent swings in the opposite direction. I expect the same thing to happen this time. I believe we'll see sovereign debt defaults spread across Europe, slowdown in Chinese growth, all pushing more and more global capital into the dollar as the best, safest alternative. In short, the dollar isn't going away anytime soon. In fact, looking back over 40 years of cycles in the dollar, I expect it to experience a strong, sustained rally over the next several years. I'm Bryan Rich from Money and Markets TV. Thanks for watching.